Ever seen the price of silver spike only to fall off a cliff moments later? You might think demand just evaporated, but that's not the whole story. Often, silver doesn't crash because people stopped wanting it. It crashes because the rules of the game changed mid-play. Let's break down the real reason behind these shocking price drops. It often starts with something called a margin hike. The exchanges where silver futures are traded, like the COMEX, can suddenly increase the amount of cash traders need to hold their positions. Imagine going to bed with a winning trade, only to wake up to a massive bill from your broker, a margin call. You're told you need to deposit more cash right now, or your position will be sold. For many traders, they have no choice but to liquidate. This forced selling is the first domino to fall. Now, why does a little selling turn into an avalanche? It's all about liquidity. In futures markets, especially during certain hours, there might not be many buyers waiting. So that initial wave of forced selling pushes the price down hard. This drop then triggers preset sell orders, known as stop losses, from other traders. This creates even more sell-in, pushing the price down further. More price drops lead to more margin calls for other leveraged traders, forcing them to sell too. It's a self-feeding downward spiral, a chain reaction that has little to do with the actual real-world demand for silver. This brings us to a crucial point: the difference between the paper market and the physical market. The paper market is where futures contracts are traded electronically, often at lightning speed. This is where the crazy volatility happens. The physical market is where actual silver bars and coins are bought and sold. While the paper price is plummeting due to margin calls and automated trading, the demand for physical silver from long-term investors often remains strong or even increases as they see a buying opportunity. The paper price you see on the screen doesn't always reflect the physical reality. So, what's the key takeaway here? These events are what we call a purge of the weak hands. Leveraged traders who are overextended get wiped out by a simple rule change. Meanwhile, the strong hands, investors with cash who understand the market as mechanics, often see this as a chance to buy silver at a discount. The rules of the market can be just as powerful as supply and demand. If you want to understand how these hidden forces really move the markets, make sure you subscribe for more breakdowns just like this one. Thanks for watching.